Imagine going through a statement. You learn how to do a balance sheet, and then later on, within the same class, the same course, you relearn how to do a balance sheet. Well, this is the video. In this video, we're going to go through the classified balance sheet, which I would have described previously in a previous lesson that this balance sheet is just a balance sheet similar to what we have already covered in the first module, but with some tweaks. So, based on the document I have placed in the file, you'll find that the classified balance sheet differs from this what we call the simplified balance sheet in that each category is can be broken down further. And so we have our assets that can be broken down into current assets, investments, property, plants, and equipment, intangible assets. And then we also have our liabilities, which can be broken down into current and long term. And our owner's equity section can be broken down differently based on the type of company it is. And so in this video, we're not going to go into the details of this, but what I'm actually going to do is I'm going to show you an example of how these balance sheets are essentially the same. The simple balance sheet and the classified balance sheet express the same information. It's just the way that it's shown that's different. So what I'm going to do is take this simplified balance sheet here and I'm just going to convert it into a classified balance sheet so you can see the process and as well so that you can see that even after doing the classified balance sheet, everything should come, the numbers and the totals for each category should still tie back. So my total assets should still be 56,000. Total liability should still be 37,000 and owner's equity should be 19,000 with total liabilities and owner's equity of 56,000. And as you can see, bada bing, bada boom, they agree. So let's get started. The first thing I'll do is the approach that I would take with this is to take it one section at a time. Because we have in the simplified balance sheet just a listing of all of our assets, all of our liabilities, all of our owner's equity, what we need to do is break down each of our categories into further detail, into further groupings. So let's start with our assets. Assets here. So we're starting with our assets, and based on the document that we had, we said, or based and as well based on the text, the categories of assets we have: a current assets, investments, property, plant, equipment, and intangible assets. Current assets they give us examples of in the book, and they're pretty standard. But these are pretty much assets that can easily be converted into cash. And so if I look at my list of assets here, I see that I have cash, accounts receivable, and inventory. These three accounts here are three accounts that can easily be generated into cash. Accounts receivable, once you collect from somebody that owes you, that's cash. Whereas inventory, once you sell an item, we can turn that into cash. So these are easily convertible. So what I'll have to put here is I'll have to put current assets as a category. And then what happens next is I would list the current assets below. And I usually like to indent. So I have my cash, accounts receivable, and inventory are the only current assets I have. And so I'll take those and I'll copy everything over. I love working in Excel because it makes it so much easier to copy and paste and with the numbers, and I can use some. So persons that are familiar with Excel, this will be a good tool to use when you're preparing journal entries and financial statements because of those added features. Word is okay, but it leaves you room for error, more room for error because you have to manually type everything in. Okay, and so the sum of these three here, So what I have here is my total current assets is 31,000. Okay, so that's my first category. The second category are investments. Investments being anything that a company holds, any assets a company holds, usually for a long period of time, that's not used in its operations. And they give us, again, an example of what investments are. So ultimately, just follow the examples that are given in the book. They list out which um, assets fall in which category. So it's definitely important to check the book out and read that information. So the next category we said we have is investments. Sorry, let's underline that there. The only investment here, we've already handled these three. We have property, plants, equipment, goodwill, investment, and shares. Because that's investment in shares, that's an investment amount. And so we can copy and paste that here as well. Worth mentioning, that seems to be the only investment on ABC Company's books. And so that means normally I don't total anything up. I just leave it, and this represents the amount for investments. The next category is property, plants, and equipment. And we would have said that these are long-term assets that are usually big in nature and in cost because there's something significant that a company buys and uses over multiple periods of time to help to generate income, to help to generate cash, things like that. And property, plants, and equipment usually is about the same type of items that go underneath there. We have the example being the building, we have vehicles, we have equipment, things like that fall underneath property, plant, and equipment. In this case, they actually don't have the name of it because normally it would be more specific. So I think I did that incorrectly. So let me just take that out there. Let's put equipment. So let's say this is equipment. Equipment falls underneath property, plant, and equipment because it is a big asset that's going to be purchased, and this equipment is going to be used to help to convert items into something that can be sold, I guess. That's a good example. So this would fall in property, plants, and equipment. So you copy this and paste it below. Again, this is the only property, plants, and equipment item. So I can kind of leave that there. I don't have to have show a total. Now, based on this, the only thing I have left, because I took the 10,000, the 5,000, the 16, the 7,000, I have not used this, and the 6,000 I've used. So what's left is goodwill. Goodwill falls underneath the intangible assets section, which are assets that don't have, you can't really touch them, but they're still an asset to the company because they provide some future benefit, or you're able to sell it to gain funds or something of that sort for the business. And so those are considered to be intangible assets. I don't have enough space here, so let me just create some more space at the bottom here. And so I would put in my intangible assets heading, category head, that's what you want to call it. And the only one I said underneath there is goodwill. And so let's paste, copy and paste, and goodwill is added. And so that's all of our assets from this side. And so let's put our total assets because we always show our total. So I can put it underneath here. Total assets. And our total assets, what we wouldn't do is we wouldn't highlight all of this, or we wouldn't click all of that. What we would say is that each category total So current assets plus investments plus property, plants, and equipment plus intangible assets. And if we look, that takes us back to the exact same 56,000 that we had from our simplified balance sheet. And that's the asset side of it. So we just converted our simple balance sheet asset side to a classified balance sheet for just the asset side. Now let's take a look at our liabilities. Liabilities is next. And so based on our liabilities, what we stated is liabilities is broken down into current and long term. Current being anything that we owe to individuals with that's payable within a year, it's due to be paid within a year. Long term being anything that's over a year. And so let's take a look at what we have here. We have accounts payable, accrued expenses, long term loan payable, mortgage payable. Now, the only thing that we can do is we can make, sometimes they tell us exactly something is short term, something is long term. So for those items that are usually tricky, they normally say long term or short term. For example, this long term loan payable. They telling us it's long term because a loan payable can be short term or long term. It just depends on what the company, how the company agrees to pay it back. So that means we know that this is long term, and that falls under the long term section. Now, what about accounts payable and accrued expenses? Well, normally these two accounts would be considered short term, and they normally include them under the short term section. There can be instances where an accrued expense or an accounts payable is long term, but unless they say long term accrued accounts payable or long term accrued expenses, we have to assume that it's short term because that's normally how those accounts are treated. And so let's get started. Mortgage payable is always going to be something that's long term as well, unless they say it's a short term mortgage. But in most instances, if you think of a mortgage, mortgages are always over a long period of time, and therefore that would fit the criteria of being due in over a year period. And so those are considered long term. So let's go back to our liabilities, and we can start with our current liabilities. Right, our current liabilities, and the only two, like we said, is accounts payable and accrued expenses, because they didn't tell us that they were long term, so we have to automatically assume that they are short term or current. And so let's put that there, and these are the only two current liabilities, so we get the sum of that, which is $6,000. Oops, did that wrong. $6,000. Next, we have our long-term liabilities. And the only long-term liabilities we have here is a long-term loan payable and a mortgage payable. Like we said again, you have to make sure, pay attention to what they say about the mortgage payable, because as long as they don't say it's short term, we are to automatically assume it's long term. So let's copy this over. Okay, let me change my formatting here. Okay, awesome. And then I can indent. And these are my two long-term liabilities. The sum of my long-term liabilities is 31,000. Now, these are all of the liabilities listed, but at the same time, I'm able to separate between current and long-term, but I also need to show total liabilities. And the total liabilities, just as we did over here, is going to be equal to the sum of our total current liabilities plus our total long-term liabilities. And therefore, our total liabilities is equal to 37,000, which again agrees to our simplified balance sheet. What's left to do after this point is our owner's equity section. And this section is kind of simple because it's really only one account. Normally in a sole proprietorship, which like I said is what we cover in this particular course, there's not much going on in the owner's equity section. And so we'll just take this information and actually copy all of this here, because all of this remains the same. There's no further classification needed for the owner's equity section, because it's in this section for sole proprietor is either the capital account or the withdrawal account. And because they tell us there aren't any other owner's equity accounts, well then we know that there's only one. And so we're just about done with this classified balance sheet, because now we have to get our total liabilities and owner's equity. And the total of that, we're going to take this total liability here plus what we have as the only owner's equity balance equals that plus this here, and dun, 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 we get 56,000 yet again now on our credit side, which also agrees to our simplified balance sheet. So I hope this helps. Hope this video helps to let you see that a classified balance sheet is pretty much just a more detailed, simple balance sheet. It comes back to the same totals for our assets, 56,000, liabilities 37,000, and owner's equity 19,000. Everything comes back exactly. It's just the way that the information is presented. In the classified balance sheet, it's now presented in categories versus the simple balance sheet. Once it's an asset, it's all lumped together. Liabilities all lumped together. But on the classified balance sheet, we now categorize it based on just the type of asset that it is, the type of liability that it is. So hopefully there are no questions on this, but if there are, use the Ask a Professor section, and I'll do my best to answer any questions that you may have on this topic. Get used to it, because you're going to have to understand how to prepare both a simple and a classified balance sheet. And so we just want you to get as much practice as possible so that when you get presented with a question, you can be able to tackle it. Enjoy.